Did you know you can contribute more to your PRAP than what the IRS wants you to? And then you can make those savings tax-free for the rest of your life. If you don't know about this technique for contributing to your PRAP, you'll want to know about it right now. That's what this video is about. I'm Dan Lohmar, CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Buell, and I are both pilots for United. Welcome to my video about exceeding the IRS contribution limits and making those contributions tax-free for the rest of your life, a very unique opportunity we have to us as pilots at United. Without waiting any longer, let's get right into it. But before we do, remember to subscribe and hit the bell icon so that you get notified when new videos come out. All right, this is for educational purposes only. Please don't take this as tax, legal, or investment advice. Seek guidance from your own advisor for your particular situation. Before we get going, just a shameless plug for the United Wealth Management website. We got a newly created one here just a couple months ago. Come over and check it out just to learn a little bit more about who we are. And if you got questions about any of this stuff, and especially if you have suggestions for video topics you would like me to cover, shoot me an email, dan@unitedwealthmanagement.com. I will be glad to do that and do my best to include that in video topics. So what are we talking about today? We're talking about contributing to the PRAP more than what the IRS really allows us to do. So those limits only apply actually to pre-tax and Roth contributions into the PRAP or any 401k. So we're going to talk about going above those limits and creating more contributions. This is a good time to review what our contributions are. I'm recording this in December, so this is a good time of year to review them because the contributions start up again in January if they've stopped for you. So it's a good time to kind of take a look at things, see how much you want to contribute, and reset those contributions on the PRAP website if that's what you want to do. Couple caveats about this is by doing this technique and maximizing our contributions, we can create maximum spillover into the RHA, okay? So a lot of people want that to happen. There's a few that don't. I totally get that, and in the future, I very well may be one of them. We cannot make direct contributions into the RHA, okay? We cannot make an election to say, hey, I'm going to put 15% of my income into the RHA. We have to do this by creating this thing called spillover, and by doing this technique, what I'm talking about, maximizing contributions up front and post-tax contributions, it's going to create some additional spillover. So a big caveat to that is if you don't want additional spillover, you may not want to do this. You probably don't want to do this. But anyway, just want to let you know that. So I don't want to make these talk about this technique without some of these caveats being known. So just to get on the same page, let's talk about the PRAP, the big picture. The PRAP is the name of our defined contribution plan. Within the PRAP, we have two 401ks. We have a traditional 401k in which contributions go in pre-tax, and we have a Roth 401k in which contributions go in on an after-tax basis. As pilots, we can contribute to the pre-tax and post-tax basis to the traditional 401k, and then we put Roth money into the Roth 401k, and then company contributions can only go into the traditional 401k. Our reason I say this is because these names, 401k, Roth 401k, and then people get them confused with Roth IRAs. In the PRAP, they throw these names are thrown around interchangeably, and each one does have a specific meaning, and it's important to know these for the what I'm talking about here. So let's talk about personal contribution limits. So as pilots, we can put into the PRAP, whether it be pre-tax or the Roth 401k, traditional or Roth 401k, we can put up to $19,500 per year, and I'm talking 2020 numbers if you're under 50, and then if you're over 50 or if you're going to turn 50 in 2020, then you can put up to an additional $6,500 of catch-up contributions, so for a total of $26,000. That age 50 rule applies through the entire year of the year you turn 50 or older than that. So those are our limits. And what we commonly think is that once we hit those limits, we can't put any more money in. But we can. So that's what we're talking about. So how can we put those contributions in? So if the Roth and the pre-tax contributions are full, so we've hit our personal limits, and if there's more room in the PRAP, we can make post-tax contributions into the traditional 401k. This is kind of what it looks like. So we've hit our limits here. We've either hit 19.5 or we've hit 26,000, depending on our limit, and the company's put some contributions in above that. And above that, you can see we have more room in the PRAP. So we've hit our limits. We have room up here. We can now make post-tax contributions to add into the PRAP and invest it accordingly. As contributions continue throughout the year, so post-tax and United contributions, once they all hit the upper limit, so it's either 57 or 63.5, depending on your age, then all contributions cut off, and we can no longer make any contributions after that. And then any future United contributions that would come in for the rest of the year, they're going to fall into the retirement health account. And again, this more so applies to if you're making big contributions, if you're senior, you're on the higher end of the pay scale. So this spillover stuff from the PRAP isn't necessarily going to apply for junior people or people who are not contributing. So it's a little bit, depends a little bit on your personal situation. So it's not something that happens automatically by any means. So here we are, we filled up the PRAP, we got spillover into the RHA, we've made these post-tax contributions, and we can no longer put anything into the PRAP. We are maxed out. And then you may have seen this email you get from Schwab, and this email says, hey, you've reached the limits, congratulations, you can't put any more money in. And the reason I bring this up is because I get asked about it about 3 times a month from the month of October on when people fill up their limits. So anyway, everything is full. Money is, from this point, might be going into the retirement health account. So we have this thing in the middle. We've made post-tax contributions after we filled up our pre-tax and our Roth portion. So what can we do with this? Well, it's in the traditional 401k. And we can do this thing called an in-plan Roth rollover. And what's that look like? Well, we made voluntary post-tax contributions in the traditional 401k. We do a thing called an in-plan Roth conversion. And basically what we're doing is we're moving it into the Roth 401k. Why would we do this? Well, because if we leave it in the traditional 401k and we let it grow there, then later on in life when we take it out, we get taxed on the gains, okay? So we do this thing called an in-plan Roth conversion, and now when it's in the Roth 401k, it grows tax-free and it comes out tax-free. So that's the reason we would do that. We would pay any taxes on very small gains when we do this, but for the rest of the time after that, the gains in the Roth 401k grow tax-free and they come out tax-free. So here's kind of a summary of what it is. Yes, it's a taxable event if there are gains on that amount. If you do it frequently, then the smaller the gains, the smaller the taxes, and there's no limit on the number of conversions you can do. So if you put post-tax money in there, let's just say, for example, from July forward, you could do one once a month if you really wanted to. Generally, what we do is we wait until the end of the year, say November or December, to make these conversions, and generally speaking, the gains aren't that big. The last one I did was for $6,300. I think I had about a $300 gain on it, and I probably ended up paying somewhere in $100 of taxes. I don't know exactly, but for that small amount of additional taxes, it's a pretty good benefit to have for that now to be tax-free for the rest of my life. And then there's no deadline. So if you call Schwab's going to say, hey, you got to have this done by December 1st. And the only reason they say that is because if you do want it done during the same tax year, then yes, it's a good idea to have it in by December 1st, so it gives them plenty of time to take care of it. But there's no hard deadline, meaning if you don't get it done by December 1st, you can't do it after that. That's all they mean by that. Once it's said and done, you get a 1099-R a couple weeks later. That's what you're going to report on your taxes. It shows you what your gross distribution is, and then plus any taxable amount on there. And once again, like I said, the more frequently you do the conversions, then the smaller the gains are, the smaller the taxes are. And then again, the big benefit here is Roth 401k. It's tax-free growth for the rest of your life, and then the tax-free distributions as long as those are qualified distributions. So it's a really good opportunity to do this. How do we do it? What's it look like on the PRAP website? Go to the PRAP, schwabplant.com, click on Manage Accounts, Change Contributions. This is where you set up your contributions. So you've got your pre-tax contributions up here. You got your Roth contributions down here, and you're going to set these up throughout the year. Like I said, right now, this time of year is the best time to do these. They're going to start up again in January. So you'd make your pre-tax contributions, and then once these are all full, that's when voluntary post-tax contributions kick in. You can preset this. You do not have to come back later in the year and set it up after your pre-tax or Roth contributions are full. You can preset this, and it's not going to kick in until the pay cycle after your pre-tax and your Roth contributions are full. So that's what the page looks like. And then once you have voluntary post-tax contributions, it's going to show up on the Schwab website under your contribution details for the year. It's going to be listed right here, voluntary post-tax contributions, and there's going to be some amount listed there along with your other contribution type amounts. And then once the conversion is done, you click on account details, and it's going to show up in here. This is a breakdown of all the different types of money that are in your account, B plan, C plan, all these different contributions or rollovers, and it's going to have a line here that says voluntary post-tax Roth conversions, and that's how much it shows in there. So we're talking just a little bit more about RHA spillover, just so we are aware of that this can create RHA spillover. So if that's not something you want to happen, this is probably not a good technique because it could cause United PRAP contributions to spill into the RHA, and it could be fairly aggressively. So you may not want to do this. But again, those aren't going to apply to everybody because if you're on the lower end of the pay scale, you can max out your contributions and your income just is not high enough that you're going to get spillover to begin with. So, but this is more for senior, more on the higher end of the pay scale. This could happen to you. This is kind of what it looks like. Again, when we get spillover, is all these contributions come in here, and once they reach these upper limits, then United has to make a contribution to something, and it goes into the retirement health account. That's if your contributions are large enough. And again, if you don't want the spillover to happen, you may want to limit your personal contributions to prevent it from happening. A couple things to do, think about when minimizing. If you want to minimize spillover, the amount that you can contribute without creating additional spillover varies a little bit based on your age and therefore the limitation of over 50 or under 50 and what your pay rate is. But a good number for wide body captains older than age 50 is $17,900, and that's the amount that you can contribute for that example in 2020 without creating additional spillover from your own contributions. And the other thing to think about that is you want to contribute and you want to save, you're trying to save as much as you can. A good technique, not talking about tax differences between now and later, a good technique though is putting that, making contributions to the Roth 401k, because once it's in there, it's all your money. You're not splitting it with the government anymore, and it's the same nominal amount, so it itself doesn't contribute to more spillovers. That's just something to think about there. How do you do this? Call Schwab, the PRAP Service Center, and you just say, I want to do an in-plan Roth rollover or an in-plan Roth conversion. You have to do this on the phone because they want to be able to document the paperwork when it goes out. So they send you the paperwork. All the instructions are on the paperwork, and just be careful. And if you have, because it is a taxable event, you have to be very well aware of that. And you want to make sure you're doing it on the right money, that you're not somehow converting all of your pre-tax money. So the instructions are explicitly on the instructions, and Schwab will talk you through that if you need that as an example. What I like to do is I like to write a hand note on there that says convert post-tax money and gains only, and just to make it very clear that that's the only amount of money we want to convert. But again, the instructions are on there. So a couple questions come up. Is there a limit on the amount of post-tax contributions? There's no limit per se on post-tax contributions, but once all of your personal contributions plus company contributions hit the total PRAP limit, then all contributions stop. And then I always get asked this is, people say, is this different than a Roth IRA, or are you talking about a Roth IRA? And they're two separate things. Roth IRA is completely outside of our PRAP plan, and the 401k is inside our PRAP plan. The only similarities is contributions to a Roth IRA and the Roth 401k are post-tax. They're grow tax-free, but as far as where they're located, they're two separate accounts, and there's different rules that apply to those things. So we're not talking about a Roth IRA. So in my next video, what I want to talk about is I'm trying to keep these videos short, so I could give a couple examples here using the calculator we use at United Wealth Management, because it shows a graphical representation of different contribution amounts. These would be personal contributions, post-tax contributions, and it kind of shows graphically throughout the year how they change and how different contributions amount change at different times. And so I don't really want to take the time to do that right now because I'm trying to keep the videos short, but I'll give a video with a couple examples like that. And then the other thing too is I think a very valuable topic really for everybody, but especially for those who want to minimize RHA spillover. A great topic is knowing how to do a backdoor Roth IRA, because now you have a place to put some post-tax money and you're not creating additional spillover into the RHA. And so those videos will be coming out shortly, and so that you know when they come out, go ahead and subscribe and hit the bell icon so that you get notified. You can see the IRS personal contribution limits to a 401k only apply to pre-tax and Roth contributions. After those are full, you can make post-tax contributions until the entire PRAP is full. We also saw that it may create a whole lot of RHA spillover. For most pilots, this is a huge triple tax-free benefit. But for those who want to limit RHA spillover, they may have the option to do a backdoor Roth IRA. But I can hear what you're saying right now. But Dan, I have money in a traditional IRA and I'd have to pay taxes on it if I do that. You're right, but with the PRAP available to us, we'll talk about a way to get around that. That's what my next video is about, so that you know when that video comes out. Subscribe now and hit the bell icon so that you get notified. And thank you for your positive feedback. It's helping me shape the content of each video. If you have a topic you want me to do a video on, leave a comment below in YouTube and I'll do my best to schedule your requests into the scheduled content. And if you like this video, give me a thumbs up. I'm Dan Lohmar, CFP professional with United Wealth Management. Until next time, invest with a plan based on science and evidence. Everything else is just guessing.